Hello, it's Simon Zucchi here, and in this video I'd like to help you understand the impact of the new budget proposals on you and your property investing. So why have I made this video? Well, first of all, there's been the shock announcement in July by George Osborne, the Chancellor, about some proposed budget changes going to come in over the next few years. And I say shock because it really has been a shock. I don't think anyone really expected the Conservative government to bring in policies like this, but it's something they're talking about, so we need to make sure we understand it. Now, the proposed changes, they will affect property investors, obviously in different ways. And there's lots of confusion about this, lots of media hype about this. So what I wanted to do was help you understand the implications and also provide some direction on what you can actually do about it. So before we start, I think it's really important to say, look, we've got to accept that the only certainty is change. You know, as professional investors, we need to be able to adapt. Things are always going to change, and it's the unprofessional people, it's the uneducated people who get stuck and get caught out. If we're constantly educating ourselves and moving forward, keeping up to date, we can adapt and make sure we're making the most of every opportunity out there. I also want to help you understand the implications for you, and it will vary depending on your personal tax situation. Now, very often governments suggest policies they want to bring in, and they don't actually get enforced because people lobby against them, they change their minds. Whitehall suggests actually it's harder to implement than they thought they could do it. So don't think that this is definitely going to happen. It probably will happen, but there's something we can do about it. And I'm going to suggest at the end of this video some action that you can actually take that might stop this particular change coming in. And finally, I need to say this video is for educational purposes only and should not be considered as financial advice. I cannot give you any financial advice. I never tried to give financial advice. It's just for education to make you aware of what's going on. So what are some of the proposed changes? Well, first of all, there's an increase to what's called the rent room allowance. Now, this is if you own your own home and you rent out rooms in that house, you could get £7,500 of rental income completely tax-free. Now, the current allowance is £4,250. So they are making a really big increase on this. And I think this is probably an indication the government recognise that there is a shortage of accommodation. So by encouraging people to rent out rooms in their homes, by increasing the tax allowance, I think they're recognising that, which is kind of strange because I think some of the other things they're introducing could actually have an adverse effect on the supply of accommodation. So the next important thing, which is a bit of a shame really, because this is a great tax benefit for us investors, I've been using this for many, many years, is the removal of the wear and tear allowance in 2016. So in 2016 this comes in. Now what this means is, at the moment, many landlords, they can offset 10% of their rental income against wear and tear. So whenever you replace a settee or a fridge, rather than claiming that expense in that year, instead you get a 10% allowance against your rental income. If you've got significant rental income, this can be a very nice tax benefit, which unfortunately is being taken away next year in 2016. So the implication here for you, just a little bit of planning I want you to think about. If you are currently on wear and tear allowance and you've got things you might want to replace, if you can hold out, if you've got a settee that's a bit grubby and you think, well, I can't really get it cleaned, I'm going to replace it. If you can wait till next tax year, 2016, you'll still get your wear and tear allowance this year, but the cost of replacing that settee will be next year when you actually replace it. So there's some clever things you can do here to maximise that if you're already using wear and tear allowance. Something that's going to affect many people who rent to LHA tenants is there's going to be a capping of LHA rates for 4 years. Now, many landlords don't like renting to LHA tenants. I've got a number of LHA tenants on single lets in some of my properties, and I've got no problem with them at all. You know, they can be very good tenants. Some LHA tenants are not such good tenants. I probably wouldn't want to have them in HMOs personally, but some people do. But it's important to understand the rates are not going to go up for the next 4 years, and that might affect the number of people who want to rent out to LHA tenants. The next thing, and this is important for those people who have properties within a business or business owners, this is a good thing, corporation tax is being lowered to 18%. Now currently it's 20%, it's going to go down to I think 19% in 2007, and a lot of these changes are going to be in place in full by 2020. So by 2020, corporation tax is going to be down to 18%. Now, corporation taxes are really quite competitive compared to other worldwide economies at 20%. So this is actually good for businesses. And The disadvantage that's linked to companies is there's going to be an increased tax on dividends. Now, many people who own a business, they will take a very small salary from the business and the rest of the profits they take as dividends because it's a lower tax rate. However, there's going to be an increase on the tax on dividends, so that might counteract some of the benefits of owning properties in the future. But the really big change, the one I want to spend a bit of time talking about, is this. It's the change to income tax relief on interest. So when we have a property and we rent it out, we can offset the interest only, not the repayment, just the interest. We can offset that against our income to reduce our profit, which means we pay less tax. That is being changed. That's the most significant thing, I believe, that I want to share with you on this particular video. So what are the effects of the income tax changes? Well, remember, these changes are not going to come in until 2017, so don't panic just yet. It's important to be aware of them. And if you are a higher rate taxpayer, you will be paying more tax. Pretty simple, you're going to be paying more tax. If you are a lower rate taxpayer, it probably will not affect you unless your income pushes you into the higher rate tax band. Now, what's the effect of this? Well, because of all the media hype, I believe this may put off some people becoming investors. Amateurs who are thinking about investing might be really put off because the media is blowing this whole thing up. And quite rightly, it is a bit of a shock thing the Conservatives have done. And hey, look, I voted Conservative, and I wonder if many people may not have voted Conservative if these changes had been announced before they got in. So, not very happy about that. Anyway, I think also some landlords who've had property for a long time might think, who might be thinking about retiring, might think, you know what, I don't want to pay this extra tax, I'm just going to sell the properties and get out of here. So I think there might be some landlords selling properties. Again, those of us who are looking to pick more properties up, this might mean that HMOs in Article 4 areas become available and people might sell them at a good price. So there's an opportunity in every threat that we face. If you're educated and you look for the positive, there's always something we can glean from this. What the net effect is, you've got less amateurs coming into the market, maybe some landlords selling up. There may be less supply of accommodation. And what that means is rents are probably going to go up as a result of this. Okay, so I think there's some good news in this, but there's something we need to be aware of, and we need to take certain actions to minimize the amount of tax we pay. So how does it currently work? So currently, tax is due on net profits, net rental profits. I'm not talking about other taxes here. I'm just talking about income tax. Okay, there are other taxes involved related to property investors, purely income tax. So if the rental income on property was £750, just one property, £750 per month, and the costs were, say, £250, that's the management, the maintenance, repairs, etc. And then the mortgage was, say, £300. What we do to work out the net profit is take the rental income less all the costs. So 750 less 250 for all the other costs takes down to 500, less the mortgage interest takes down to £200 net profit. And currently you are taxed on the net profit you make. Now, by the way, if you make a loss, that loss can be offset against future years. But let's assume you've got a portfolio making money and this particular property is making money, you'd pay tax on it. Now, you're taxed at your marginal rate, whatever that might be. So if you're a lower taxpayer, 20% is the standard rate. On the £200 profit, 20% of that is £40. And if you're a higher rate taxpayer, you pay tax at the 40% rate, so you'd pay £80 tax. So lower rate taxpayer £40, higher rate taxpayer £80, that's a tax you'd pay on the rental profit right now of £200. By the way, the taxman looks at your whole portfolio. So if you lose money on one property, that loss can be offset against the gain on another one. But let's assume all your properties are making profit, which is what they should be doing. So that's the current situation. Now, what's the effect going to be on lower tax rate payers? Well, not really much change. Let's have a look at this. So rental income, same property, 750. The costs are still 250. Now, what the Chancellor is saying is no longer will you be able to treat interest as a cost which you can offset. So in other words, technically, according to this new definition, the profit is going to be £500. Okay? Now, if you were to be taxed at 20%, the standard tax rate would give you a tax you have to pay of £100, whereas previously it was £40. So this looks like you're going to have to pay more tax. But what he's done is he suggested actually there's going to be a flat rate of 20% tax relief on interest. So With the interest on your mortgage at £300, 20% of that is £60. So that relief gets taken off the tax you need to pay. So the actual tax would be £40, which is 100. The new tax less the relief of 60 gives you 40. So in reality, it's the same tax if you are a lower rate taxpayer. It's very important to understand that. Now let's look at the effect if you are a higher rate taxpayer. So rental income of £750, same scenario, cost of £250. The net profit is going to be £500 if you don't include the interest anymore. So 40% tax would be on the profit of £500. So 40% tax would be £200 of tax, where previously it was 80, so a huge amount more tax you're going to have to pay if you're a higher rate taxpayer. But wait a minute, remember there's the flat 20% tax relief on interest. The interest is £300, the tax on 20% of that is £60, so you take the £200 less the 60 to give a new tax of £140 payable by the higher rate taxpayer. So in other words, it's an extra £60 more than before. Okay, remember previously it was 80, now it's 140, so an extra £60. So higher rate taxpayers, if you don't do anything about this, you are going to be paying more tax, which is why a lot of people are affected. Now, who is going to really be affected by this? Well, if someone's on a lower rate tax and they've only got 1 or 2 properties, they may not be affected because they're paying effectively at the lower rate. I think this is going to hit the real middle class person who might have a good job, and because of that job it means they're already a higher rate taxpayer. It means the additional income they get from the property is going to be taxed at the higher rate, so those people are going to be hit. Or people who've got lots of property and they've got a substantial income from that property. However, I would suggest that the more sophisticated investors are already doing things to minimize their tax anyway. So how's this going to affect you? Well, it really depends on what's your strategy. Are you buying property because you want to get a rental income now, in which case this will have effect, or are you trying to build a pension for the future? Also, what tax rate are you at? If you're lower rate and you're going to stay at lower rate, it's probably not really going to affect you. If you're at higher rate, it definitely is going to affect you. And also, how have you purchased your properties? Have you bought them as an individual or have you bought them in a company? And there are pros and cons of both of those, again, depending on your tax situation. We'll look at that in a moment. But that will affect how this affects you. And finally, do you intend to purchase any more property? Maybe you've got enough property as it is and actually you just need to manage what you've currently got. You might just be starting your property journey, trying to work out what's the best way to structure it for tax purposes. So these are some of the things you need to think about. So a big question is, should we invest as an individual or should we invest as a company? Well, it depends on your strategy and personal tax situation. A very, very general rule of thumb that we used to use was this. If you are looking to buy and hold for the long term, which means you might want to remortgage as the values goes up and you're not planning to sell, typically buying it as an individual is best. If, however, you're looking to trade property where you buy it, you renovate it and sell it, what's called flipping property, a company was probably the best way to do it. And this is based on the different tax rates between the two situations. Also, within companies, there aren't as many mortgages available as there are to individuals, but with these changes, maybe mortgage companies might start thinking, you know what, we're going to start having more mortgages available for companies. So that might well change in the future. But before everyone suddenly rushes to get a company to put their property into, there are some disadvantages. You see, if you make money in your property, the profit is taxed at a lower rate, especially with corporation tax coming down, than as an individual. However, if you want to extract your money from that company, you'd then pay tax. And as we said, the tax on dividends is going to go up. So actually, there's a double tax. So you need to be really careful. So a lot of people are saying, oh, I'm going to put all my property into a company. Well, if you already own property and put it into a company, you would pay capital gains because effectively you're crystallizing the gain. So you've got to think very, very carefully about this. And I recommend you get some specialist advice from an accountant who really understands property tax. So what can you actually do about this? Well, if you own property right now that's giving you an income, there are 3 particular tactics you can use. The first one is this. If you own property and you're in a partnership and you own it jointly, so you're tenants in common, what you can do is you can actually adjust the percentage ownership. So let's say someone in the family has a lower income and someone else has a higher income. You change the ownership so the person with the lower income owns more of the property, which means they get more of the rental profit, which will be taxed at their lower rate. And the person who is the higher tax rater owns less of the property, so they get less income, which is taxed at the higher rate. Okay, that's the first thing you can do. Or you could set up a management company to collect all of your rents. So if the rental income is coming direct to you at the moment, put a management company in place that can take some of the profit. That will get taxed at the lower rate. But remember, to get the money out of that company, you might pay a tax charge. Well, you will pay a tax charge. So just be aware of that. Interestingly, if you're doing a rent-to-rent strategy, this doesn't really affect you because you're not paying mortgage interest. You're paying a fee to the owner of the property. It will affect the owner of the property, but it won't really affect you. The other thing you can do is you can offset repairs and maintenance costs against income. So let's say you buy a property that needs some doing up, as most properties do, and you want to put a new kitchen in. If you're replacing the kitchen for the existing one, you're not adding to the property, you're just replacing what was already there, repairing it. Instead of having that as a capital cost, which you can offset against capital gains if you sell in the future, you can offset it against income because it's an income expense, and that cost can be offset. Now, that means that maybe on your property you might make technically a loss for a couple of years if you've got all these costs you're going to offset, but that loss can be carried forward each year. So just think about that. And again, maybe seek professional advice about this. I just want to educate you and stimulate your mind as to some of the things you can do. If you want to build a pension for the future and you don't really need the income right now, you might invest in a slightly different way. Maybe you might buy in a company. Now, the idea of this is you buy the property in the company, the value of the property goes up hopefully over time, you're getting rental income coming in, but you don't take any drawings from it. It makes profit, it pays its corporation tax, but you don't take any money out. You let the profits build up over time, and then you only draw on the income when this is your sole income. So you might have a job at the moment or a business that's giving you a good income that makes you a higher taxpayer. If you don't need the cash right now, you could have this business building the profit, reinvesting some of the profit, getting more and more property, such that when you retire, when you want to quit your job, when you want to sell your business, then this can then become your main source of income. And you need to decide how much money you want. But you can earn up to currently about £40,000 before you become a higher rate taxpayer. So you could draw this money as an employee, or in fact you could pay other family members and utilize their tax allowances if they're lower rate taxpayers. So that's what you might do if you're in a company. So what's the action you need to take now? Well, very simply, don't panic. These are proposed changes. Some of them may not actually come in. It's really important you understand what they are and how they can affect you. Make sure you understand specifically your given circumstance and get some professional advice to make sure you don't do one thing that you think is going to save you money, find it's going to cost you in another way. Now, there's a petition. There's a petition out there, and I'd encourage you to go and sign the petition. If you go to my Facebook page, it's Successful Property Investing with Simon Zucci. You'll see the petition on there. You'll see a link. You can click through. You can sign up to it. It's a government-run thing. If they get 10,000, I think it's like almost 9,000 when I signed up. If they get 10,000, they have to acknowledge this. If they get 100,000, they have to debate it in Parliament. With 1 million landlords, there's no reason, if we all start telling people about this, we can get them to really debate this and wonder, is this really a thing they want to do or not? The other thing you might want to do is subscribe to this channel to keep up to date with important changes. As things happen, I'm going to share them with you, and it's really important to keep up to date with your knowledge. So my name is Simon Zucci. I do hope you've got some education and ideas from watching this video. If you would like to share it, please do. If you want to put a comment on there, please do as well. I'd like to see your comments. Thank you very much.